February 2022. Ottawa is frozen. Not metaphorically. Physically frozen. The streets are packed with trucks, diesel fumes, flags, police lines, idling engines, and people who still think the boundary between politics and private property is intact. A welder, a delivery driver, a single mother who sent $50 to a cause she believed was lawful, a man with a mortgage due in 6 days. None of them imagine that the most important weapon in the scene is not a baton, not a tow truck, not even a judge. It is a spreadsheet entry inside the banking system. The Canadian government invoked the Emergencies Act on February 14, 2022, and the related emergency measures expanded anti-money laundering rules to crowdfunding platforms, payment processors, and even digital assets. By February 23rd, authorities reported 246 financial products frozen, 57 entities disclosed to financial institutions, and 253 Bitcoin wallet addresses shared with virtual currency exchangers. No dramatic trial, no years of litigation, just a fast translation of political designation into financial incapacity. That is the scene to keep in your mind for this entire video. Because the argument over programmable money is usually presented as a debate about convenience, faster settlement, better inclusion, cleaner payments, less friction. But that is public language for a much darker institutional possibility. Money that can be watched completely, routed conditionally, delayed automatically, and denied selectively. And once money can do that, your freedom changes shape. You can still speak. You can still vote. You can still post. But can you buy fuel? Can you receive wages? Can you pay rent? Can you move savings without permission? That is the line history cares about, because systems do not become authoritarian only when they imprison bodies. They become authoritarian when they can immobilize ordinary life. So this is not a video about the future in the abstract. It is a forensic examination of how money becomes a control surface, what its architects have already admitted, where populations have resisted it, and what remains outside its clean administrative reach. The first mistake people make is to imagine programmable money as a new kind of cash. It is not. Cash is anonymous enough to function without permission at the point of exchange. A note in your hand does not ask where you earned it, whether your purchase fits a policy objective, or whether your profile has triggered a compliance rule. A retail CBDC can be built very differently. It can combine identity, ledger visibility, intermediary screening, and rule-based execution inside one payment environment. The architecture matters more than the branding. BIS material is explicit that retail CBDC design turns on choices around identification, privacy, data governance, and the allocation of roles between central banks and intermediaries. That is where money stops being merely money. Once a transaction depends on authenticated access to a digital system, the power in the system shifts from possession to permission. The question is no longer, do you have value? It becomes, are you allowed to use it here, now, for this purpose, through this channel, under these conditions? That is not a philosophical concern. It is a design question already discussed by the institutions building these systems. BIS work notes that effective identification is central to safety and integrity, and its CBDC research repeatedly frames architecture in terms of compliance, governance, and policy functionality rather than simple digital convenience. And then there is the sentence that stripped away the euphemisms. In October 2020, at an IMF panel on cross-border payments, BIS General Manager Augustin Carstens said that with cash, central banks do not know who is using a $100 bill. But with CBDC, the central bank will have absolute control over the rules and regulations that determine the use of central bank liability, and also the technology to enforce that. The importance of that statement is not rhetorical. It clarifies the institutional ambition. Digital money is valuable precisely because it can carry conditions and because those conditions can be executed technologically, not merely requested legally. Now, to be fair, not every CBDC proposal is equally invasive. Some designs claim stronger privacy protections, tiered anonymity for low-value payments, or private sector intermediaries between citizens and the central bank. BIS papers discuss these options openly, but that concession misses the real forensic point. Once the monetary rail is technically capable of surveillance, filtering, or conditional use, privacy becomes a policy setting, not a structural right. And policy settings change fastest when institutions are under stress. That is the threshold. Programmable money is not dangerous because every authority will use maximum control every day. It is dangerous because the control surface exists at all, waiting for the moment officials decide that ordinary rules no longer apply. The next layer is where programmable money stops being merely observable and becomes behavioral. Most people can understand surveillance. Fewer understand expiration. In China's digital yuan pilots, local authorities used ECNY distributions and consumer red packets with spending windows attached. Reuters reported in May 2022 that Chinese cities were using digital yuan to stimulate consumption, and earlier pilot distributions in places like Shenzhen came with fixed validity periods. That distinction matters. Even where the official ECNY itself is legal tender, specific disbursements delivered through the system can be structured to push speed, place, and purpose of spending. In other words, the authority does not need to abolish money's permanence in every context. It only needs the technical option to issue some units with policy conditions attached. That is a profound break from the historical character of money. Ordinary cash is inert. It may lose purchasing power through inflation, but it does not contain a timer set by its issuer. A programmable disbursement can. It can be made more useful in one district than another, more useful this month than next month, or unusable after a deadline if the policy objective is velocity rather than saving. Bloomberg noted during China's early rollout that a programmable currency could allow expiration dates on stimulus-type payments to encourage spending in downturns. The BIS in its own survey work distinguishes between programmable payments and programmable money. But the line is thinner in practice than officials often imply. Once the payment environment wallet layer and disbursement terms are all centrally designed, the citizen experiences the condition as money behavior, not as a legal footnote. And this is where the issue becomes human, not technical. Imagine being paid on Friday in a form that must be spent by the end of the month. Imagine receiving a subsidy that works for groceries but not fuel. Imagine a crisis-era payment that can be used only inside approved merchants, only inside approved geography, only before a date chosen by people you will never meet. The official language for this will be efficiency, targeting, stimulus precision, leakage reduction, better transmission. But from the street, the lived experience is simpler. Your money has stopped being a stored claim on future choice and become a script you are instructed to perform. To be precise, the strongest documented examples in China often involve time-limited ECNY promotions or voucher-style distributions through the digital yuan infrastructure, not proof that every unit of digital yuan permanently self-destructs. That distinction is important, and exaggerating it only weakens the case. But the forensic lesson survives intact. Once monetary rails can carry expiry logic at all, the taboo has already been broken. The power to decide whether money stores value or merely transmits policy is no longer theoretical. It is technical, administrative, and waiting for stress. If China shows what programmable money can do from above, Nigeria shows what people do from below. Nigeria launched the e-Naira in October 2021 as Africa's first central bank digital currency. On paper, it promised inclusion, efficiency, cheaper payments, and a stronger digital economy. In practice, adoption remained weak. An IMF review of the first year found that the project had not moved beyond an initial wave of limited uptake, with low activity and weak network effects. A separate IMF paper noted that household adoption was slow, merchant usage was limited, and many wallets appeared inactive. Then came the stress test. In late 2022, the Central Bank of Nigeria imposed strict cash withdrawal limits as part of the Naira redesign process. The revised circular set weekly cash withdrawal limits of Citi 500,000 for individuals and Citi 5,000 for corporate bodies across channels, with tighter ceilings for ATMs and point-of-sale cash access. As old notes were withdrawn and replacement notes proved scarce, the country experienced severe cash shortages. Reuters reported widespread hardship, anger, and disruption, serious enough that the Supreme Court later extended the use of old banknotes. This was the moment the theory met the street. If a population truly trusted the official digital rail, this should have been the breakthrough moment for the era. Cash was constrained. Digital alternatives existed. The state had every incentive to push migration, but populations do not adopt a monetary system because policy papers call it modern. They adopt what clears transactions, preserves optionality, and works under stress. In Nigeria, many people routed around the official vision instead of embracing it. The IMF's own assessment is blunt. Limited adoption reflected low trust, weak incentives, and the difficulty of overcoming entrenched payment habits and network effects. That is the forensic lesson. Money is not accepted because it is technologically elegant. It is accepted because ordinary people believe it will still work tomorrow. In a crowded market, during a shortage, with unstable power, weak connectivity, and rising fear. When that belief breaks, people reach for what is usable, not what is officially preferred. And that is why resistance to programmable rails rarely begins as ideology. It begins as survival. This is where the conversation usually becomes unserious. One camp says the answer is crypto. Another says the answer is gold, cash, fuel, food, tools, silver coins, farmland, anything you can touch. Both camps are partly right. Both camps also ignore the same forensic rule. An asset is only defensive if it remains usable under the specific failure you are trying to survive. Start with self-custody, crypto. Its advantage is obvious. Properly self-custodied digital assets are not a bank deposit. They do not sit inside a retail account that can be frozen with a compliance instruction to your domestic bank. If you control the keys, the asset is harder to seize remotely than an ordinary balance in a permissioned financial institution. But harder does not mean frictionless. Crypto still depends on electricity, devices, connectivity, wallet literacy, key management, operational discipline, and, at the point of conversion into daily life, some bridge back into a merchant or payment network. During the 2022 Canadian emergency measures, authorities shared Bitcoin addresses with virtual currency exchanges, showing the obvious pressure point. Self-custody may resist direct confiscation, but the on-ramps and off-ramps remain exposed. Canada, K. Now compare that with physical tangibles. Cash gives immediacy and privacy, but only within the shrinking geography where cash is still accepted and available. Gold stores value densely, but it is clumsy for small daily exchange and vulnerable to spread, assay, and trust problems in stress conditions. Fuel, medicine, tools, spare parts, food staples, and household essentials are not elegant stores of wealth, but they have one brutal advantage. They collapse the distance between ownership and use. You do not need an app, a compliance department, or a market maker to eat rice you already hold or run a generator with fuel already stored. So the real question is not, which asset is best? It is, which failure mode am I defending against? If the threat is inflation, one set of assets matters. If the threat is account freezing, another set matters. If the threat is grid instability or civil disruption, the hierarchy changes again. A self-custodied digital asset may beat a bank balance against remote administrative seizure. A shelf of essentials may beat both when the immediate problem is continuity of life over the next 7 days. That is the mature view. You are not looking for a magical asset outside history. You are building layers with different seizure paths, different dependencies, and different use cases, so that one administrative action cannot turn your entire life into a permission request. So here's the deliverable, not a slogan, not a silver bullet, a test. Call it the analog wallet. Take every asset you own and divide it into 4 columns. First, remotely disableable. Bank deposits, payment apps, brokerage cash. Anything that depends on an institution updating a screen to confirm your access. Second, institutionally gated. Retirement accounts, custodial investment products, exchange-held crypto, stored value systems, and assets you own, only through a compliant intermediary. Third, self-custody but infrastructure dependent. Hardware wallet crypto, encrypted records, digital tools, even some forms of remote work capacity. These are stronger against direct administrative seizure, but still rely on power, hardware, connectivity, and your own competence. Fourth, physically held and immediately usable. Cash, food, water, fuel, medicine, tools, essential spares, in some cases, precious metals. Assets whose usefulness does not begin with permission. Now the question becomes brutally simple. Which column can be frozen with an email? Which column can be disrupted by a power outage? Which column can carry your household for 72 hours? Which column can carry it for 90 days? Which column still works when the official story says everything is normal, but the card reader says otherwise? That is the real defense against programmable money. Not paranoia, not fantasy, just dependency mapping. Because privacy is not nostalgia. It is decision-making space. And convenience is not neutral. It is often the price by which institutions train populations to surrender the friction that once protected them. The choice at the end is clean. You can live entirely inside systems that know you, score you, and can pause you. Or you can preserve a layer of life that still functions when those systems decide you are a problem.